So Joel, what are the benefits of holding an investment property in an LLC from a tax perspective?
So holding a property under an LLC, the main reason you want to do that is because, first of all, you never want to hold a property under a corporation, and I'll get into that. But if you have a real estate property, first of all, you don't want to own it under your personal name because you have unlimited liability. So if someone were to sue you, they can basically come after your property. So by having it under an LLC, you have limited liability protection. So that's the main reason you want to hold real estate under an LLC. But some things or some errors that taxpayers do is that they actually will want to purchase property under a corporation, and that's a huge mistake because, first of all, you don't get what's called a step up in basis. And so what a step up in basis means is that when you pass away, your heirs usually receive that asset. Well, under a corporation, you don't get a step up in basis, but you do get a step up in basis under an LLC. And you also get it personally, but then you don't have that limited liability protection. So which means that your heirs will actually inherit the property at fair market value. So meaning that if you sell the property right away, you don't actually pay any taxes on the sale of that home, even though maybe the equity has gone up $100,000 to $300,000. But if you have it under a corp, you actually don't get that step up. So you definitely want to make sure it's under an LLC versus a corporation, and you don't want to have it in your personal name because then you don't have any limited liability.
That's a really, really interesting point. So you're saying that if you hold the property into an LLC and you pass away and that property's passed on to your heirs, the amount that property has appreciated in value will not be they will not be taxed upon when the property is sold. It will just be what they purchased the property at?
Correct. Yeah. So basically the heirs inherit the property at fair market value. So whatever, if it was your grandparent who purchased that property or your parents who purchased that property and they purchased it 30 years ago when the house, let's say, for example, you had a property that was worth $200,000 back in the 90s and your parents bought it. Now it's worth $700,000. It's increased in value by $500,000. Well, if you inherit that property from your parents at $700,000 and you immediately sell it, then you actually, the heirs, the kids, basically pay no taxes on it.
That's awesome. That's awesome. It's good to know too. Okay, next question is, so Joel, how does having a monthly mortgage payment lower your tax liability?
So if you actually have a mortgage payment under your personal name, as your primary residence, it's not going to give you a huge benefit, unfortunately, as of 2018 because of the Tax Cuts and Jobs Act. So basically what they did in 2018 is they increased the standard deduction. They doubled it from $6,000 it was at the time to $12,000 for single taxpayers, and then for married taxpayers from $12,000 to $24,000. So you, like for a married taxpayer, for example, their mortgage interest, their property taxes, as well as their charitable donations have to be more than $24,000, which for most taxpayers, unfortunately, they're below that. So they're better off taking the standard deduction anyway. So when we prepare their return, we let them know, yeah, we included your mortgage interest, but it actually made no difference on your return. Now, if it's for a rental property, though, that's completely different because the interest is tax deductible under an investment property, and that there is no standard deduction. It's going to just be deductible. The only, I guess, downfall, though, would be if you're a high income earner. If you make more than $150,000, then you're actually not allowed to you're still allowed to deduct interest, but it gets basically suspended until future years. And so you actually don't get to use those deductions until you either sell the property or you have income below $150,000. But if you're below that, then you have an investment property, then you'll get that interest deduction. On an investment property, on a primary residence, it depends, but usually not.
Gotcha. What is the most common deduction that business owners overlook?
So there's so many deductions that taxpayers are entitled to. And the biggest thing that I always tell my clients is, especially if you're just an individual, there's not a lot of deductions, unfortunately, if you're just a W-2 taxpayer. But once you're a business owner, almost everything is tax deductible, right? The only criteria the IRS has is that it has to be ordinary and necessary for your business. That means You got to use your cell phone for business. That's deductible. You have to use your internet for business. That's tax deductible. You have to use your vehicle for business. That's tax deductible. So I always tell my clients, say, don't ask me if it's deductible. Ask me, how can I make it deductible? Because if you make it business related, it now becomes deductible. I'll give you an example. If someone wants to go on a vacation, normally that's for personal pleasure, which would not make it deductible. But if you go to that trip and you own a rental property in that location and you went to go visit the tenants while you were there, and then, by the way, I had some fun and vacation, well, now that entire trip is tax deductible because you made it business related. Mm-hmm. So I always tell my clients, don't ask me if it's deductible, ask me how, and if there's absolutely no way how, then I'll let you know. So I just think that the biggest tax deduction that most people are not taking advantage of is just ultimately not being a business owner, because there's just so many tax write-offs that you can deduct.
You know, it's crazy that you say that. I mean, it's not crazy. It's obviously fairly obvious, but, you know, being in the business of looking at people's income, if anyone were to ask me the quickest way to, you know, really make some money to get wealthy, you got to be self-employed.
Oh, 100%.
Yeah.
Yep.
Okay. Joel, what is accelerated depreciation, and when would it be a good time to implement accelerated depreciation?
So whenever you purchase an asset for either business or for investing, you get to depreciate it. So for example, if you purchase a residential property for investing, not your primary residence, then you get to depreciate it over 27 and a half years. If you purchase a vehicle for your business, you get to depreciate over 5 years. Now, accelerated depreciation is basically a law that says you can depreciate the asset sometimes all in 1 year, sometimes in accelerated methods. For example, let's do vehicles, for example. If you are in business and you purchase a vehicle that weighs more than 6,000 pounds, you get to qualify for 100% bonus depreciation, meaning that if the vehicle costs you $70,000, and let's say you bought it on December 31st and you didn't even have to make a down payment. Let's say you just completely financed 100%. You get to deduct $70,000 on your tax return because of 100% bonus depreciation. So that is considered accelerated depreciation. Now, whenever a asset has a life of more than 15 years, then you're not allowed to take bonus depreciation, which basically any asset that has a life more than 15 years, basically real estate. So residential, for example, per the IRS regulation, has a life of 27 and a half if it's residential. If it's commercial, it has a life of 39 years per IRS. So you will not be able to take bonus depreciation on those assets. However, there is a tax law where we can kind of manipulate that, and that's called cost segregation, which basically means that engineers will come to the real estate office or the building, whether it's residential or commercial, and they'll separate the asset into different useful lives. They'll say, okay, the carpet, for example, is only going to last 5 years. The roof's going to last 15 years, and they just start separating it into different asset lives, and then everything else is 27 and a half, or everything else is 39. Well, again, if an asset has a life of 15 years or less, it now qualifies for 100% bonus depreciation. So now you get able to take on real estate 100% bonus depreciation on an asset that typically would not be.
That's really interesting. So the cost segregation aspect of that is actually breaking down the different things that make up the asset itself. And we're saying, okay, well, that's not necessarily the asset that is real estate, but we can depreciate those things 100% and then make up a portion of that accelerated depreciation.
Exactly. Yeah. And I think the biggest, most people unfortunately don't do that unless they have a CPA like myself. And then they'll just depreciate it over its normal life of 39 years, where you could have depreciated most of it, all in 1 year. And then you can even play with the numbers. Let's say you don't want to take 100% bonus depreciation on an asset like the carpet that has a 5-year life, for example. Maybe based on your numbers, you're like, I'm going to spread that over the typical 5 years. Or you might say, no, I'm taking 100% bonus. So that's where a CPA like myself can come in handy.
For sure. And that's like any real estate mogul's dream, right? Like that's what they use.
Oh yeah,
Time
that's
to
really the way that if you look at Donald Trump, and it was all over the news that he only paid $750 in income tax. Well, where does he do for a living? He invests in real estate. So 100%, if you want to, reduce your tax liability, it's definitely an option.
That's good stuff. Okay. Joel, are points paid on a mortgage tax deductible? And if they are, does it matter whether or not those points are paid on a primary residence versus a secondary or investment property?
Yes. So points are deductible, and it does matter if it's a primary investment or an investment property. If it's a primary or secondary, it's going to be factored into that standard deduction, meaning that your mortgage interest, the points, the property taxes have to be basically more than $24,000 if you're married or $12,000 if you're single, which if you're paying a huge amount of points, then it's possible that you could exceed that. But if you're not paying a whole lot of points, then you're still going to be under that. So primary, secondary, unfortunately for most taxpayers, I have to give them the bad news. Yes, it's on your return, but it didn't make a difference. Now, if it's for an investment property, then yes, you get to deduct 100% of the loan points. Now, if you're refinancing the loan, though, you actually still get to write it off, but you have to amortize it over basically the life of the loan. So if they refinance into a 15-year loan and they paid points to refinance, well, then they can deduct it, but over 15 years. Or if they refinance into a 30-year mortgage, then they have to amortize it over 30 years. But on a purchase, it's 100% all in 1 year.
Gotcha. That's really good to know on the refinance. I did not know that.
Yep.
Information. What about mortgage insurance? Is mortgage insurance deductible? Does that also go into the standard deduction?
So mortgage insurance always changes based on the tax laws. Mm-hmm. Last year, I believe it was. I mean, it changes every year based on who's the president, who's in administration. So, but it does get factored if it's a primary or secondary. It does get factored as a standard deduction. If it's a investment property, then it's deductible all in that year. But again, whether or not it's deductible, it depends on the administration at the time.
Sure. So, Joel, would you have any advice for someone that's looking to do a 1031 exchange?
So if you're planning to sell your property, one of the biggest benefits is doing a 1031 exchange, because you can basically defer the capital gains onto the next property. So if you bought a property for $100,000 years ago and now it's doubled in price or doubled in value, now it's worth $200,000, you typically would have a capital gain of $100,000, which means you're going to end up paying a whole lot of tax. Well, if you do a 1031 exchange, you can actually defer that $100,000 of capital gains onto the next property, which could basically means you don't have to pay any taxes on that property. Now, the downfall that I actually have come across is that some people don't realize that they actually have to use an intermediary. They'll actually say, oh, well, I bought another property. And I was like, well, did you touch the money? And they're like, yes, I did, but I immediately purchased a different one. I'm like, well, that's not a 1031 exchange. You actually have to use a intermediary which actually does the paperwork for it. And I have had to give them the bad news that they're going to end up having to pay taxes on it, even though they don't have the money because they've already put it all into a property. So that you definitely want to be educated in that aspect. But it's a great way that wealthy people have basically reduced their tax liability. And the beautiful thing about 1031 exchanges is that you can continue to defer and defer and defer, and it's unlimited. And going back to the fact that the heirs will get a step up in basis, basically you will inherit the property at fair market value. So all those capital gains that were deferred over the years are going to be completely washed away when you pass away, because your heirs now inherit the property at fair market value, which means your legacy will not have to pay any taxes.
That's good stuff. That's good stuff. Awesome. Wow, I appreciate it.
Cool, man.